And welcome to the financial planning update for October 2021. My name is Matthew Smith, Managing Director of Buckingham Chartered Financial Planners, and as usual we will begin with an update on how the markets are doing year to date. We've seen a continuation of previous trends here, that the US market continues to motor ahead and has now pulled significantly away from the UK market. You may recall some of the earlier updates in the year where the UK market was actually running ahead, which is quite an unusual state of affairs if we look at the last decade. But the normal service has been resumed, and we see the US market now posting very impressive gains, 22% for the year. FTSE 100 lagging behind on 16, but still a fairly impressive performance nonetheless. Now, what's also interesting is if we look at things over a longer term, this is the last decade, and we can see here markets now pushing or testing all-time highs, the UK being again the notable exception that's just struggling to nudge past its previous record. What's also stark here is the divergence between the US and the UK market performance. US having grown nearly 420% in the last decade, the UK having grown by 92% during that same period of time. Now, had I said to you back in November 2011, would you be comfortable with 92% growth over the next 10 years? That's nearly 9% a year. I think most people would be happy with that, generally speaking. But the US has really outperformed and has contributed, as we know now, the vast majority of total global returns to the market. The portfolios have had a strong month, so they started off on a bit of a downer following the end of September. This was largely driven by inflation fears, which certainly haven't gone away, as we will see in just one moment. But October has been a very strong month for all of the portfolios. And if we look at the year-to-date position, once again, we're very happy with how the portfolios are performing. All of them very much ahead of target for this time in the year, and hopefully, barring any major upsets, are on track to deliver above average returns based on their targets. Now, many people are interested in the active versus passive portfolios. When I gave the update a while ago, there was actually a bit more of a divergence, but you'll notice during October that the two portfolios have come back together to the point where the two are almost touching. There's barely any difference between them now. And as we announced at the client event, we are planning on making a shift with the active portfolios into more sustainable investments to differentiate the two. So there will be more that will go through on this side with clients during review meetings, which we're hoping to have late in quarter 4 or early quarter 1 next year. So we'll talk about the portfolio options and any decisions that need to be made as a result of that. Now, what's really becoming clear is that the so-called transitory inflation is probably not so transitory. I think originally when inflation started to spike, there was a sense that it was purely the pandemic impact working its way through the system. But what we now seem to have are far more structural problems in the economy that are causing inflation. All of these things have been very widely reported. We have things like shortage of HGV drivers, increasing natural gas and resource prices, shortage of stock in supply chains. All of these issues are coming together to drive inflation, and it continued to increase in September going through into October. Now, the consumer prices index, which is the widely reported index, is now hovering around 3%. But retail prices index is actually pushing 4.5% now on a year-on-year basis. And what we're seeing is central banks are now beginning to gear up to act against rising inflation. And of course, the usual planning action to prevent inflation is to increase interest rates. So if we look at the minutes from the most recent Bank of England meeting, it suggests that they are now strongly thinking about increasing interest rates. And the market, if we look at stock market predictions, they're now forecasting 2 rate increases by the Bank of England before Christmas. So we could well see 2 modest increases to the Bank of England base rate before the year is out. Now, this has all sorts of implications on the rest of the market. So The 10-year gilt yield on UK government bonds is now 1.2%. Not that long ago, it was only 0.2%. So the yield on a 10-year government bond has increased very substantially. Most people would probably think that 1.2% is not an awfully exciting yield, and they'd probably be correct. But we have to bear in mind that that is still 12 times now the Bank of England base rate, so that there's definitely a disconnect now between the base rate and yields. During the budget today, the Office for Budget Responsibility has forecast that we're going to see 4% inflation for probably most of next year. They're forecasting an average inflation rate of 4% through 2022. So I think it's fair to say that the Bank of England will have to act on interest rates. There is a difficult balance to strike here, however, because of course increasing interest rates, generally speaking, slows down economic growth. And the recovery from the pandemic is still relatively fragile. We've just had the furlough scheme come to an end. We've got all of these other supply chain issues going on. So although the growth figures published today in the budget were very robust, as was the forecast for growth next year, I think it's fair to say that that's quite fragile growth. So the Bank of England is in a bit of a rock and a hard place situation here, where they'll want to curb inflation, but they won't want to move too quickly on interest rates to prevent stalling what is currently a fairly impressive recovery. Now, it would seem that the Bank of England will be the first major economy to move on interest rates. The Fed in the US and the EU Central Bank not likely to raise rates until much later into 2022. So to a certain extent, the UK is going to be the guinea pig here. We will be the first major economy, it would seem, to increase interest rates, and we will see how that plays out in the next 6 months or so. Now, the impact on markets, I think, will depend on the Bank of England's guidance. And in recent months, they've been very keen to give this forward-looking guidance to avoid surprising markets, which I think fundamentally is a good thing. It gives markets time to plan and adjust for any potential rate rises, and just avoids those nasty surprises that we all know that stock markets tend to dislike quite a lot. So we will keep a very careful eye on guidance from the Bank of England as we approach the end of the year. Now, I'm just going to mention trust registrations again briefly. We have now fully digested the requirements, and we now are preparing a full list of every single trust that we have ever created for clients. So there will be a personalised communication programme going out in Q4 and Q1. For those clients that have an ongoing financial planning service with us, we will pick up trust registration during review meetings. For all other clients, there'll be emails and letters going out shortly to advise of the requirements and how we might be able to assist in meeting trustees' obligations. Now, today was the day of the budget, and from a personal finance perspective, it really was nothing to see here. Lots of announcements about business investment, lots of announcements about borrowing and growth forecasts, etc. But from a personal financial planning perspective, the budget was very, very quiet indeed. We didn't even have the usual announcements about things like the tax-free personal allowance, because most of those things have been set already or they've been frozen. So the only real personal financial planning announcements were things to do with alcohol duties, which of course affect people indirectly, and a few announcements on universal credit, but no major changes to income tax, capital gains tax, inheritance tax. So it's very much a maintenance of the status quo from that perspective in all of the main areas of personal taxation. As always, there may be some devil in the detail, so we'll be scrutinising the budget document in the next few days, but nothing major to report from a personal financial planning perspective at the moment. Now, the final thing to mention for today's update is that in future video updates, we're going to be exploring some more advanced financial planning concepts. We tested this out with our client advisory board a couple of weeks ago, and the feedback was incredibly positive, and people were very keen to understand some of these ideas in more detail. So we're going to be exploring some of the more advanced financial planning concepts in future monthly video updates. Now, if these things you believe might be appropriate for you, you probably need to book a meeting and we can talk things through in more detail. But we're going to aim to give you a very high-level overview of some of these more advanced financial planning concepts to see if they might be appropriate in your situation. So that's everything that we have for today. It's scary to think that we're just about to head into November, so 2 more updates to go this year. I hope you and your family are keeping well, and as always, if there's anything we can do to assist, please do get in touch with a member of the Buckingham Gate team.